I'm going to be talking about our equity strategy in general. Over the last 2 years, the Citadel view has been very much pro-equities and definitely pro-global equity. So in any of our clients' portfolios, our allocation to the equity asset class and to the global asset class has been an overweight position. And a lot of that's been driven by 3 key fundamental trends that would be best described as crocodile jaws opening up. And as they've widened, they've created an enormous opportunity for our clients, and we've definitely benefited from in the last year. The first one, and the most important one, is on the global equity side. We've had an unbelievable bull market in bonds for 30 years. So global bond markets have been the place to be for 30 years. And we know definitely over the last 10 years, global equities has absolutely not been the place to be, and the earnings and results and returns have been very disappointing. And you finally got to a point about 18 months ago where your bond yields were at record lows. And when we say record lows, 200 to 300 year record lows. So extremely low interest rates. And yet at the same time, bond markets being so low, equity markets being at record high yields, in other words, very attractively priced. And that crocodile jaw got as wide as it has ever been in history. And in our view, thus creating an opportunity to sell out of bonds and to buy equities. That gap has now closed quite significantly, and just last year alone, you got way over 20% in your equity markets in dollar terms, and in fact, you had a negative return in bond markets. So definitely the correct place to be. Our clients benefiting from it. The question is, where to from here? That jaw has started to close, but not completely. So we still stick to that trend, and we think there's more to come. The next significant trend we're seeing within the global equity market is the difference between valuations in developed markets versus emerging markets. Over the last 3 to 4 years, emerging market returns have disappointed, whilst the developed market returns have started to look interesting. Those of you can recall, at the beginning of the decade, or the 2000s really, emerging markets were very strong in relation to developed markets. And we've finally got a new crocodile jaw developing there, where the valuations of developed equities are starting to look more in line with long-term averages, whereas the valuations of emerging market equities are now also starting to touch historical lows. And again, with that crocodile jaw opening, the option to have a higher weighting in emerging markets has now raised its head. And is this an opportunity? Compared to a year ago, the companies and the countries, two together, are in much better shape than what before. Just in general, corporate governance is better, country balance sheets are better, company balance sheets are better, and the earnings growth prospects still remain good. So what we've now decided to do in our portfolios is to up the exposure to emerging markets as that crocodile jaw has opened up. This crocodile jaw hasn't closed quite yet, and at the moment it remains one that's wide, and we think is an opportunity for our clients. So yes, we have a lot in global equities, but we're starting to tilt the portfolios to a little bit more emerging markets than what we've had before. That's a very interesting crocodile jaw that has opened and widened over the last year, but it is yet to pan out in returns for our clients and start to narrow again. The final crocodile jaw is within the local markets. I think most of you are aware that we've had a phenomenal bull market in South African equities for the last 10, 15 and 20 years. It's been a very strong place to invest your money, excellent returns, way ahead of expectations, and definitely way ahead of inflation. And the issue now is that our domestic equity market is expensive. So where are the opportunities, and how can you try and generate some kind of a reasonable return in this environment? And this is where the third crocodile jaw comes into play. The resources sector has been very disappointing since about 2007, 2008, admittedly at its peak, whereas the industrial sector has been extremely strong. And we know all the stories. We know that the Naspers have performed, the retail stocks have performed, Richemont's, etc. And you have got to the point where that third crocodile now, the jaw, is as wide as it has been in history. Extremely high valuations for industrial companies and record low for the resources companies. Just last year alone, you got 38% out of the industrial companies in 1 year, and you got 2% out of resources. That crocodile jaw, we think, is presenting the third opportunity within the equity environment. So we definitely think, yes, your returns in South Africa will be muted, and the returns that you will get will be coming from the more attractively priced sectors, and particularly resources in particular. And it does look like that the industrial returns will become more muted and possibly even give you a negative return. So the equity market in general is very exciting. 3 crocodile jaws, global bonds versus global equity, definitely an opportunity now for global equities that has begun, and we think it can continue. The other opportunity within global equities is emerging markets versus developed markets, and again we think that emerging market opportunity is looking very good. And within South Africa, resources versus industrials. Industrials are very expensive, resources looking very attractive, and we think that will probably be the best place to generate probably a moderate but definitely a reasonable growth going forward. Thank you for your time. Until I see you again.